ZIRP is back. The zero interest rate policy that everyone said would never be seen again has made its reappearance. The central bank in Switzerland is the first to achieve that unwanted milestone. But that's only where it begins, not where it ends. The central bank over in Sweden cut its interest rates down to 2%, historically low territory, after earlier this year declaring confidently there would be no more rate cuts from that part of Scandinavia. There are always more. Rate cuts are like the old Pringles ad. Once you pop, you can't stop. In fact, I told you this was going to be the case 15 months ago. In March of 2024, the Swiss were the first to pop the Pringles can, and when they did, I said this.
The Swiss have a message for the Fed, the ECB, and everyone else. We know you're going to be cutting rates and maybe be cutting them by a lot. The dovishness, where is it coming from? Well, according to everyone, it comes from everyone else. And even the Swiss said, the issue here is weakness abroad.
And it certainly was a warning, but not just for the Fed. They, like every other central bank, has done just that. And now with the Swiss in ZIRP and Sweden coming along, we have more proof there's further to go on the downside for both the global economy as well as these various central bank rates. Why? For one, both Switzerland and Sweden are prime examples, along with everything in China, that rate cuts don't work. Global factors are what matter. And these series of rate cuts all around the world are simply a response to them. Therefore, we watch and pay attention to what these central bankers are doing, because if they're responding, that means even the most insanely biased and slow to react bureaucrats on the planet must also be seeing these same global factors. And yes, this applies to the Fed, even if the Fed's dots today seem hawkish. They were hawkish the same way exactly 1 year ago, and what happened? The Swiss were right, not the dots. What the Swiss National Bank was saying in its own backward-looking way was that inflation wasn't sticky, so central bank rates were not going to be sticky either. The globally synchronized, forgot-how-to-grow economy was in danger of forgetting even more. That's why they've all acted. And all we've heard, even since then, from everywhere, from all of the mainstream media, from economists, was inflation, inflation, inflation. I told you, as the markets did way back then, this was going to happen. And now we're seeing it happen from one central bank after another. What does it look like? As I've been saying, the 2020s more and more resemble the 2010s. And it's only a matter of time before Federal Reserve and Jay Powell realize the same thing and then act the same way. The Pringles can pops for everyone. I mean, just take a look at how globally synchronized central bank policy rates have been to begin with. There's very little variation this cycle, and that's nothing new either. Go back to the middle 2000s, and especially after 2008. Central bank policies like the global economy was synchronized. And then everyone hiked rates starting in 2021 and 2022 because it wasn't inflation. It wasn't as if one country after another was witnessing local money printing. It was instead the global economy suffering a global supply shock that led to a global phase shift in prices. And when the global economy forgot how to grow starting in 2022, that signaled an end to the phase shift and therefore removed any further inflation threat. It took central banks, however, forever to finally start realizing this, which is why they didn't start cutting until last year. Once that happened, look what happened. They all started cutting together, and not just one or two like they cautioned at the start. There were Pringle cans everywhere, even in Jay Powell's mouth. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. So now here we are, the Swiss National Bank. The Swiss started this rate cutting cycle back in March of 2024, and they're the first to get back to zero. They have reintroduced ZIRP into the world, and no, to be clear, that's never a good thing. Zero rates are not stimulus. What they do say is that the worst cases are now on the table. As the Swiss National Bank statement from today said, in its baseline scenario, the S&P anticipates that growth in the global economy will weaken over the coming quarters. And it's a bland statement that doesn't really say much, but that's central bankers' way of telling you, as low as we've gotten so far and as low as we've seen inflation and the overall economy go, we know it's going to get even worse. But where it really starts to look like the 2010s all over again is in terms of what they call inflation. The constant inflation misses, the inability to explain why, and then of course central bank policies that always chase consumer price rates lower along with economic growth. That's exactly what the Swiss National Bank is doing, and that's exactly what they said here to do, very reminiscent of the 2010s. Back to the Swiss statement. Inflationary pressure has decreased compared to the previous quarter. With today's easing of monetary policy, it's neither easing nor monetary policy, the S&P is countering the lower inflationary pressure. The S&P will continue to monitor the situation closely and adjust its monetary policy if necessary to ensure that inflation remains within the range consistent with price stability over the medium term. And they said that all last year too, including up in December where they cut rates by 50 basis points and declared how the 50 basis point rate cut was going to keep prices from turning negative. Then they turned negative, and now here's the S&P forecasting several more monthly negatives, but then moving the goalposts, now saying that, whoa, they don't care about monthly negatives, they only care about consumer prices over the medium term. Appearing on CNBC, as he always does following a Swiss National Bank meeting, Chairman Martin Schlegel said, "The current negative inflation for us is not a reason to lower interest rates. For us, the important thing is the medium term." And then he followed that up by saying one or even several negative consumer price rates in the short term are, quote, "not really relevant for us." So again, he's moving the goalpost by saying we cut rates so that we never see a negative CPI. Then once they see a negative CPI, what does he say? Well, we're not focused on negative CPIs in the short run. We're more worried about consumer price rates over the medium term. Okay, but it's the medium term that's also being downgraded because that's where everything's going in the short run, and it continues to go in the same direction. They can't seem to get this right. Like the Pringles can, once they pop and start cutting policy rates, it just continues to go forward because consumer price rates don't respond to local interest rate cuts. They're based on negative global factors. In fact, you go back to December 2023, the Swiss National Bank forecast that the Swiss CPI would dip to 1.6% and then level off around 1.6% by the second quarter of 2025, or right where we are today. Fast forward to March of 2024, their first rate cut. Then they predicted that consumer price rates in Switzerland would dip instead to 1.2%, but also level off there in the first quarter of 2025. So while everybody else around the world was talking about higher for longer sticky inflation, I told you to watch the Swiss National Bank because that was the future for both consumer price pressures as well as central banks responding to them. Get to September of 2024, now the Swiss forecast that the consumer price index was going to fall down to a 0.5% rate by the second quarter of 2025, and then maybe slightly rise, but only to 0.7% afterward. And then in December 2024, when the Swiss actually cut by 50 basis points, they trimmed their forecast yet again, saying that consumer price rates were going to dip down to a low of 0.2% here in the second quarter of this year, and then it was still going to rise to 0.7% thereafter. They didn't change the forecast in March. In fact, they raised it a little bit because of that 50 basis point rate cut. But here we are in June. Now they're saying that the second quarter of 2025 is going to have zero consumer price inflation, though they still have the forward years rising to 0.7%, but now not until 2027. So the Swiss National Bank went from leveling off at 1.6% in 2025 to now today, maybe, hopefully, possibly hitting 0.7%, but not until the middle of 2027. It's exactly what I said before. This sounds exactly like the middle 2010s, because in many ways it is the middle 2010s emerging here in the 2020s, given the bad economics that the entire world is trying to deal with. The forgot how to grow economy that developed out of governments everywhere impoverishing the world for the pandemic and the lockdowns. These were the inevitable consequences of it. This is what markets have been pricing. And here's central banks coming along after inflation, finally confirming in their own way that yes, this is the growing possibility. This is the way the world is moving. And the way it sounds like the middle 2010s, we saw this any number of times in any number of places. Central banks would forecast rising inflation and stable growth, largely because of their quote-unquote stimulus policies, but the economy would only slow, consumer price rates would dip, and central banks would respond all over again with even lower policy rates. Then they forecasted those would work, only to find out they never did. And the cycle repeated over and over again to the point that interest rates went down and stayed there basically for the entire decade of the 2010s, along with our chances for any recovery or economic growth. Because low interest rates, they're not stimulus. They're a response to economic weakness and nothing more. And of course, the Swiss went even further today because they have to, where Chairman Martin Schlegel said they're going to consider negative rates. But then he tried to downplay it on CNBC and some of his other media appearances by saying, well, the hurdle for going negative is much higher now. Wrong. The hurdle for them is just getting interest rates and inflation wrong. The lower they go and they're already at zero, the more likely they're going to have to go even lower. I mean, bond yields, as I pointed out recently in Switzerland, they're already significantly negative. And with the way everything is going around the world, the Swiss National Bank will be negative at its next meeting, and they'll be talking about how CPI rates will be negative in the medium term, but how they're focused on the long run. They'll keep moving the goalpost, keep moving their policy rates lower, because global conditions are what matter, and they're moving the global economy that we see reflected in Switzerland in the wrong direction, in the direction back toward the 2010s. As the World Bank admitted just recently, the average growth projection for the decade of the 2020s is now less than it's been at any time since the 1960s. Again, the 2020s look at the very least like the 2010s, if not even worse. And a lot of this, too, from the Swiss National Bank has to do with the Swiss franc. Not that that's any different. That's not a distinction, because the Swiss franc is the other side of everything. The Swiss franc tends to rise during periods when the global monetary system is afraid of economic and monetary and financial conditions. Therefore, the Swiss franc tends to rise as flight to safety, risk off, risk aversion, which is the same thing. So if the Swiss National Bank is lowering rates because the Swiss franc is high, they're still responding to negative global factors all around this entire global system. And what we've seen from the Swiss franc is that there's every reason to believe that the Swiss National Bank is going to have to react to it further down there. Even if they're already at ZIRP, negative rates are the future. Because the Swiss franc has been rising since the middle of January, coincident to the bond market turn in treasuries and German rates and others, had a huge jump higher in early April along with the deflationary outbreak. Even though it didn't peak until the middle of April, it has stayed high the entire time. Only a small retracement to around 0.85 in the middle of May, but since the middle of May, over the last month, the Swiss franc has been moving stronger again. Not a good sign, along with negative Swiss rates, and now these policy rates that are reflecting all of these same globally synchronized conditions. But as I said in the introduction, Switzerland and its zero interest rate policy is only where this begins, not where it ends. Now, of course, Switzerland, the Swiss interest rates and Swiss policy rates don't get all that high to begin with, so they don't have very far to go before they're back at zero and even negative rates on the other side of it. But the Swiss are just representative of this entire globally synchronized Pringles can process. Over in Sweden, the Riksbank, they did announce that they cut their policy rate by an additional 25 basis points, which brings it down to exactly 2%, or right on the edge of historically low territory. Now, they had last cut in January, and when they did, Swedish officials said they were done. They didn't just say it, they put it in their forecasts and in their models. The models showed that they were sticking with 2.25% for the foreseeable future, which was all the way out into 2027. Now, you have to understand that the Swedish economy has had a very rough time the past few years. It's one of these economies around the world that really forgot how to grow. I mean, GDP, like everyone else, fell way off track starting in the third quarter of 2022. And as a result, unemployment has been rising by a lot. But GDP turned positive in 3 of the 4 quarters last year, so Swedish officials at the Riksbank thought that was it. The recession was done, that Sweden had somehow remembered how to recover. And so the rate cuts, which began in 2024 from the Riksbank, were believed to have cemented what they all said was a recovery. Even the unemployment rate dipped slightly in the fourth quarter of last year. So in January of 2025, what the Riksbank did was they hung out the mission accomplished banner behind them and said, we did a great job, we got Sweden back on track, now we expect it to stay that way for the foreseeable future. But globally synchronized factors had other ideas, and I'm not talking about tariffs. Rather than continue on toward recovery, GDP stumbled in the first quarter, first estimated to have stagnated at 0, which instead of the small positive that was expected. It has since been revised downward to minus 0.2%, the first contraction in Swedish GDP since the fourth quarter of 2023. And like Japan, we see Sweden as re-recessioning, which means it never really left the recession or never really forgot how to grow. But worse than that, the unemployment rate in the first quarter shot up to an astonishing 8.9%. Big jump from the fourth quarter of 2024. And remember, this is the first quarter of this year before tariffs were implemented, during the artificial high and the artificial push to a front load activity before the tariffs too. So not only is the 8.9% unemployment rate in Sweden the highest since the third quarter of 2021, as you can see, it very nearly equals the highest rates in 2020 and 2021. And worse, outside the lockdowns, it's the highest unemployment rate there since the first quarter of 2010. So the statement put out by the Riksbank underplays everything, but at least it gets to the basics. What it says is the economic recovery that began last year, it wasn't a recovery, has lost momentum. There's your not recovery. And inflation is expected to be somewhat lower than in the previous forecast. Where have we heard this before? The executive board has therefore decided to cut the policy rate by a 0.25 percentage point to 2%. The forecast for the policy rate also entails some probability, again downplaying it, some probability of another cut this year. And then finally, where have we heard this before? The lower interest rate will stabilize inflation at the target and contribute to strengthening economic recovery. They always promise that rate cuts will work, that it'll stabilize consumer prices and contribute to an economic recovery when it does neither of those things. These rate cuts are always a reaction to the weakness that develops, surprising all of their forecast models and the policymakers and their understanding of how the economy works. So they don't understand how the economy works, which is why they cut rates to begin with and why they're always surprised when they have to do so. So Swedish rates are already down at 2%, which is historically low. It's also equal to the ECB, and both of them are strongly implied to go below 2% at some point, and the markets are certainly pricing that way. While many people think, well, okay, that's Switzerland and Sweden and Europe, that it's a European issue or an outside the United States issue, it's also an issue for the Federal Reserve. As I stated last March, the Swiss National Bank was sending a warning to all these other central banks in the world, but also to the Fed. And unlike the Fed's plans at the time, the Swiss National Bank warning proved to be prescient. I mentioned this on yesterday's live stream where I ranted about the absurd FOMC meeting yesterday. If you go back 1 year ago to June of 2024, and you look at where the FOMC dots were then, what they showed was that most of the FOMC were leaning toward a single rate cut at most for all of 2024. And then you looked at their 2025 projections in the dots, and they showed around 100 basis points of cuts. In other words, their own forecast for 2025 ended up being what happened in 2024. Their dots were off by a whole year. They should have listened to the markets and to the Swiss National Bank because the rate cuts instead came faster and went farther, which is exactly what we were talking about in March before they even considered the possibility of rate cuts. The Fed is no different. It's just lagging behind everyone else, and that's not a change either. Globally synchronized. The central banks are reacting to globally synchronized factors, and eventually they all end up in the same place anyway. So the Swiss are back at zero while confirming they're considering negative rates. Global macro variables and the global climate overall leave them no choice. The Swedes are back at 2 while confirming they're considering going below 2. The macro variables there, especially frightening unemployment, also leave them no choice. And on we go in one place after another that looks exactly like the place that you just left and just looked at. And all we've ever heard from the mainstream is inflation, inflation, and inflation. Yet here we are, right where I told you we'd be. And the markets were spot on with all this, which is why you never hear about it. If you want to see the live replay of me ranting about the utter unseriousness of the Federal Reserve and the absurdity of them abandoning their job, that's the video I got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.